Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
With more on the currency trade and declines in the U.S. dollar, Bloomberg News FX and rates reporter Carter Johnson is here in the Bloomberg Businessweek studio. The declines that we continue to see in the U.S. dollars, the flows behind it. What's the story that's telling you?
Sure, absolutely. Thanks, Tim. Thanks, Carol. And I think what's really interesting is we can look at this on a pretty long timeline. So I'm starting to hear comparisons late last week, today, yesterday, to this feels like early 2025 and Liberation Day all over again. And that's just because, yes, we're seeing some action in stocks in treasuries, but really this is a real sort of dollar-focused impulse to sell. And of course, on a shorter timeline as well, we can think about that in the context of what we saw last week, which was some pretty concerted movement in dollar yen specifically. And that was, as we reported, likely because some folks here in the U.S., the New York Fed acting at the behest of the Treasury, were reported to us to be checking rates and sort of calling into some banks and seeing where exchange rates were trading. So on a couple different levels, sort of in the near term and in the big picture, as you mentioned, Carol, questions about the U.S. fiscal position, policy uncertainty, those are all combining right now.
Carter, reading in this morning, Bloomberg reporting out the positioning is heavily one-sided. They said since Thursday, roughly 2/3 of options trades in the euro and the Australian dollar have been bets on further greenback weakness. So is this largely about dollar decline and not about bets on other currency strength backed by fundamentals?
It's a great question. I think the answer, honestly, is both. And a lot of that impulse, as we just talked about, is because of a declining dollar and questions about U.S. policy. But we are seeing relatively solid growth expectations in the rest of the world, whether that's Europe, maybe that's in Asia. And that really underpins the impulse to sell dollars as well. If growth in the rest of the world was cratering at the moment, we wouldn't be seeing this sort of action we're seeing in terms of dollar sales. So it's absolutely the other side of the coin as well.
We've got stock investors watching and listening to this program. What is the relationship between weakness in the dollar and what happens in the equity market? I mean, you made the comparison minutes ago to kind of feels like April 2025, and we all remember what happened to the equity markets during that time.
Absolutely. And I think that's the big question is, will we see that again, where typically you'd expect to see the dollar weaker as stocks strengthen. They have a negative correlation, particularly the dollar as a traditionally haven asset. We didn't see that late last year. The stocks, the dollar, treasuries, they were all falling together. So I think that's the big question right now is, will we see that again? I don't think we are yet. But in sort of a different picture as well, a weaker dollar should theoretically support domestic manufacturers. It should support exporters here in the U.S. That's typically what we'd see on a lag. But we also know that that's something the Trump administration has been vocal about as well. A weaker dollar theoretically, again, doesn't work instantaneously, but theoretically supports domestic manufacturing and exporters who are looking to sell to the rest of the world.
Hey, one other thing I want to ask you, though, but is it about global investors, and we've talked about flows into European equities, is it another sign, perhaps, that global investors are less interested in dollar-denominated investments?
It is possible, although I think it's too early for us to say at this point, as we knew last year. We don't have that data yet necessarily. And again, if we look at just the relative performance of U.S. stocks, they're doing all right. They're certainly holding up. I think what it could definitely be indicative of, and this is something we've covered a bit here at Bloomberg in the past, is hedging behavior. And what that means is you're a global investor invested here in the U.S. You might still want your exposure to U.S. stocks and U.S. tech, but you're going to hedge that dollar component of that much more than maybe you used to.
Mentioned Jay Powell tomorrow, the press conference. What are you watching for from your perch as somebody who watches FX?
Absolutely. I think just as we are in the rates in the Treasuries world as well, any sort of forward guidance that we can get from Chair Powell, that'll be a tall order given the spotlight he's under at the moment. But any sort of future guidance about the outlook for rates this year, that'll be particularly impactful for the dollar as well as rates.
Right. If for any indications that there's higher rates coming, we're talking about that could put a floor under the dollar, correct?
That could definitely help. Yeah. And, it's
Maybe.
funny. Yeah, no, for sure. JP Morgan, when they came out with their big currency forecast late last year, they're bearish on the dollar, but the big risk to their bearish dollar view is the Fed has to turn around and hike. Again, we might not see that, but that's the risk.
Although there is, it feels like a growing conversation about inflationary concerns, which would certainly lead the Fed certainly to keep rates as is or possibly hike them. We'll have to see. Carter, thank you so much laying out the currency trade for us as we continue to watch the U.S. dollar. He's Bloomberg News FX and rates reporter Carter Johnson.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The group of airline stocks as a whole off about 2% today. Here to talk about that, we're also going to talk about Boeing, which also reported today, is Sheila Kayalu. She is Managing Director in Equity Research at Jefferies. She joins us here in studio. Nice to have you here. Happy New Year.
Thank you for having me.
I know January's over, but
Almost.
Let's just start with airlines, and then we want to move into defense, because you cover that really closely as well. It does feel like they're all finding their way back after the storm. We're trying to see if there's another storm. In terms of the impact, is it still a case of they're still trying to assess? How do you, as someone who covers some of these names, kind of factor that in?
Yeah, in terms of airlines, we're looking for revenue growth. We've seen the same trend across American that we saw at United and Delta. Corporate was up 12%. Corporate momentum continues. I'm taking a very long flight this weekend. And then main cabin weakness, but it's getting a little bit better. And it's all about cost control. That's why I think United went up the most on earnings, is they really beat out on costs when American Airlines margins came in 100 bips below our estimate. So I think the most polarizing stock is going to be Southwest. I'm really excited for their report on Thursday because they have some lofty targets. The stock's at $40 today. Some people think it's going to 30. Some people think it's going to 80. It's all about they're adding extra legroom seats, and is the strategy going to work?
But that's a huge shift for Southwest. I mean, they're essentially moving away from their DNA, what they're known for, and the culture that they're known for, and that's alienated some people already.
Yeah, it depends. So the average Southwest fare is about $109. So if you add an option for extra legroom or refundable or seating, if you add $50 to that cost of that airfare, so $159, that's a 50% increase almost. Does the passenger back away? I'm not sure. But then again, it's only $159. So how do we think about that? And what adoption do we assume? We're at about 5% adoption in 26. They have a bunch of other benefits as well, baggage fees and cost optimization. So that's driving their EPS to $3, essentially EBIT tripling off of a very low 25 base. So we'll see how much of that they get. Some people think they could get to $4 or even $5 as more of that extra legroom adoption comes in. But it's their first go at it, and we'll see how it takes off.
You have a $45 price target. So you're not at the 80 and you're not at the 30. So maybe a little bit higher from where we are?
I would prefer United, where they've, if you think about United, they're going to be accounting for 44% of the new premium seats through 2028. So they're going to be accounting for more than any other airline in the U.S. Americans after that, and Southwest because of their extra legroom. I prefer to bet on that corporate customer paying $1,000 plus $100 to achieve that additional corporate fare and that higher margin where United is adding its seats than Southwest adding on the, I think both are, given the multiples that they're currently trading at, United is more appealing to me.
Let's talk some defense, and then we'll talk some Boeing too.
Sure.
I want to look at shares of RTX. They're higher right now by about 3.4%. Profit topped Wall Street estimates, a sign of momentum that the company awaits a potentially huge jump in U.S. military spending. That's kind of where I want to start. What we've heard from President Trump in the last few weeks, not just with the idea of a $1.5 trillion defense package, but also calling on some of these companies to do a better job, pay their executives less, and also build stuff for the U.S. government more quickly. What are these CEOs to do?
There's a lot going on in defense, and that's why I was saying it's an exciting sector to cover, because this is the first time that the 5 primes might no longer exist as 5 primes by the end of the Trump administration, which is our view. We think that there's going to be, similar to what LHX announced 10 days ago, there's going to be more deconsolidation happening among the primes. Their budget is going up by $500 billion from $1 trillion. We don't know the time period of that spending. We don't know how much will be added to actual equipment and R&D versus military operations. But they're seeing an increase, whether it's to fund defense tech names like Firefly, Voyager, the recent IPOs we've seen in the space, or the traditional primes. Or suppliers like AeroVironment, Kratos are up 100% on the year already, and we're 27 days in. So it's really interesting to see what happens in defense, but there's a lot of shakeups that I think are going to play out. So it's about seeing who has the best positioned portfolio and who to play from here.
I was surprised, I know when you walked in, we started talking, and I mean, aerospace defense, just the S&P broad index up about 9% year to date, up about 46% last year. Is it just because defense spending all around the globe is just happening and everybody's amping it up?
It's tremendous.
Is it as simple as that?
Tremendous growth. Internationally, 20% plus, NATO budgets, Japan, Korea. We're seeing countries like Serbia put in orders that never used to put in billion-dollar orders for equipment to companies like Elbit in Israel. Coupled with the defense budget going from $1 trillion to $1.5 trillion makes defense very interesting. And the administration has been very supportive of defense tech, emerging technology companies that had stagnant revenues for the last decade are seeing 30, 40% growth.
But, as Tim mentioned, when the president talks about an industry, it can be good or bad. So is it good that they're on his radar? But when he's
not when he says only pay CEOs $5 million.
We're talking about CEOs.
He did back off of he didn't quantify in the executive order the pay,
but he mentioned it in the social post earlier.
Yes,
it's a headline that caught our attention.
And $5 million, it sounds like a lot of money, but not for a CEO who's paid over $20 million.
Right, the executive pay, the average executive pay, I would assume in any sector is over $20 million. So the caliber of folks you would get into defense would be the opposite of what the administration's trying to achieve.
So what do you hear from defense companies about getting some attention like that from the president? Do they kind of brush it off a little bit? We're talking with them.
I think one interesting trend we've seen from the reports, whether it was Northrop or Raytheon today, is the lack of buybacks, because that's what the administration asked for, a focus on additional CapEx. Raytheon mentioned that, Northrop mentioned that, Boeing mentioned that. So across the board, everyone's like, sure, we're investing, we're going to get you supplies on time, that's our job, and it helps funnel the growth.
The Northrop CEO saying Northrop is balancing the need for performance with affordability and speed to market to meet the U.S. Defense Department's focus on speedy development.
Yes, and I think Kathy Warden, the CEO of Northrop, said this was the best spending environment she's ever seen in her career. So most of these executives are very bullish.
Do the upstarts in defense tech pose a threat to the incumbents? And I'm thinking of, an Anduril that is not yet, and I say not yet because obviously this company, I'm guessing, will IPO at some point soon. Do they compete with these incumbents?
Yes, clearly they're competing and they're collaborating. They're working together, both internationally and domestically. The primes are trying to work with, Northrop has a partnership with Kratos on CCA. It's a autonomous vehicle, essentially. So we're seeing a lot more collaboration, but they're also trying to take share. But the budget is growing overall, and that's the bottom line. Although we're not really seeing it in 26. Northrop's guidance is 5% growth. They talk about an acceleration from there in 27, 28. Same thing with Raytheon. It was modest growth in defense. It didn't really pop. Yes, it grew in the second half versus the first half, and we'll see how those trends continue.
I feel like with all of the geopolitical tensions and the wars that we've seen around the world, that everybody comes back to the U.S. military might and the defense companies here in the United States. What is the global picture? Where's the competition? Is there not much global competition, Sheila, when it comes to the U.S. defense companies?
So I think it's focused on maybe a few things. First is missiles and munitions readiness. We need to have that available, and that's why we're seeing companies like Lockheed increase PAC-3 production from 600 missiles a year.
What's PAC-3 production?
It's a missile. PAC-3 is the name of the
Got
missile.
it.
Going from 600 units a year to 2,000. That is significant, to say the least. That's $8 billion of additional revenues to Lockheed over 7 years if they could ramp to those levels. The backlog's 20 years for a missile like that. We're seeing that across the board. LHX 10 days ago or 2 weeks ago now announced that they are seeing a government investment within their solid rocket motor business that powers missiles. They're going to open up 60 factories next year. LHX currently has 250 factories. So that's the magnitude of investment we're seeing from the government. So focus on missiles and munitions. And second, I think it goes back to old school warfare. Everybody thinks helicopters are over and F-35 is a bad program. But if we think about Venezuela, if we think about Iran, what's the kind of equipment we're using? So, it's not necessarily rebuilding an entire fleet for the Navy, but it's doing things that we could use pretty quickly.
Just in the last 90 seconds, I want to hit Boeing with you. Shares are down today by about 1.8%. The company did report this morning a second straight quarter of generating cash, 57% bump in sales during the final 3 months of the year. Shares down, though. Is it because of accounting charges for the KC-46 tanker program? Is that it?
No, everybody just assumes that's going to happen every quarter.
Okay.
So we're all good there.
Why are shares down after a quarter
so
that looks pretty good?
Shares opened down. The call at 10:30 got it up to it reversed about 4 points, and then they're down again. We're a believer in Boeing. Their underwriting, their free cash flow was a loss of $2 billion in 25. They're talking about positive $2 billion at the midpoint in 26. Normalized for one-time items, they're saying their free cash flow is high single digits, so say $8 billion. They're reaffirming their $10 billion target, and then they're saying they could go above that. So, 10, 15, it's giving long only is a reason not to dismiss the stock. If this company could actually earn $10 billion of free cash flow, then it's quite compelling at its current valuation. So we're seeing a lot of fluctuations. Are they talking back 27, 28? No, I think that you're going to see $2 billion in 26 and an improvement in 27 and 28.
So Boeing, let me just say, you've got a 290 price target. It's at 244. You feel good about that?
Yes.
You want to raise it? Or?
We are supportive of Boeing. We think there's a few positive catalysts. I think President Trump might be headed to China in April. We'll see if Boeing heads there. We haven't seen a China order since, I can't even recall, maybe it was 2019, maybe earlier. So I think Boeing works from here. Depressed prices for Maxes, maybe 50% below what they historically sell at today.
This was fun. Come back soon.
Sure.
All right. Sheila Kayalu, she's Managing Director in Equity Research at Jefferies, joining us here in studio.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We do head back to the White House and Bloomberg News senior reporter Jen Delowy. Jen, good to have you here with us. We know President Trump on his way. I don't think he's landed yet, but we know there is a crowd in Iowa waiting for him. He did say en route to Iowa, talking to reporters, he's meeting in terms of Tom Homan, the border czar. He said he's meeting with the governor in Minnesota. He's meeting with the mayor, I think, later, and I hear that's all going very well. What are we hearing? Is it all going so well?
Early reports out, we don't have a great deal of intelligence out of those early meetings, but what we are seeing, of course, is this effort by the president, it appears, to dial down the temperature, to do really two things: to express support for Homeland Security Secretary Noem, and at the same time, who's obviously been criticized for her handling of these incidents and her characterization of them, and then at the same time also try to find a way forward with local leaders. The president repeated that comment to us several times before he headed out to Iowa, saying that he believes the conversations with the governor of Minnesota are going very nicely. And of course, he was previewing that later conversation today with Mayor Jacob Frey.
I was surprised to hear, just based on the reporting that we've seen in the last 24 hours, that Tom Homan was headed to Minneapolis. Some of the reporting from other outlets indicated that Kristi Noem had been sidelined in some way. She was at a meeting at the White House yesterday. It reportedly went a couple of hours, according to other outlets. How are you reading into that reporting? Has she been sidelined? The president earlier expressing his support for her, saying she will stay on at the agency. How are you reading into that?
It's important to appreciate that departures aren't always telegraphed well in advance. But for now, the president is very clearly, insisting that she has his support. That meeting, first reported by the New York Times last night and stretching over 2 hours, included her top aide, Corey Lewandowski, the first campaign manager from Trump's 2016 presidential bid. And also, it's notable that they came out of that meeting with the president's messaging today about not backing down from her. And in fact, when asked about Noem's performance, he immediately pivoted to talk about, how she's done a great job on the border. Traditional deportation, focused comments from the president there. Notably today, on the way to Iowa, on the plane on Air Force One, Trump is joined by his senior advisor, Stephen Miller, who had also drawn a lot of criticism, just like Noem, for his initial characterizations of the shooting over the weekend. Stephen Miller had intimated on social media that the man shot on Saturday was an assassin and domestic terrorist, even though video evidence suggests he had been disarmed and hadn't brandished a weapon.
Hey, Jen, in terms of, I was going to ask you about who's the architect of all of this, and I think there's been a lot of reporting, but does it really matter because the buck really stops with the president, to be fair?
The president, this president in particular, takes ownership of his policies and has been quite happy to tout his deportation agenda. It's something he campaigned on so vigorously, and in office has really claimed as a source of pride that he's accomplishing his goal of deporting illegal immigrants.
Mm-hmm.
What is,
and
of
not
course,
the only president to do it, right? We can go back to the Obama administration, to be fair, because I think it's important to kind of point that out.
But, Stephen Miller is seen internally as, of course, a big factor in this push. Obviously, someone who's been critical of the, amount of immigration and illegal immigration into the U.S. But to your point, Trump has taken ownership of this. This is as much his issue as it is that of a key ally and aide. And it's one where we've heard him talk very openly about being frustrated with the messaging on this. Last week, he lamented that, the focus hadn't been on the rapists and murderers, as he characterized them, that were being deported. He even, took to the White House briefing room last week to show pictures of some of the deportees. So that, kind of speaks to his frustration that the messaging has shifted away from where he wants it to be. And of course, that he's lost some control over the narrative here. Polls show that even among folks who care, who support his broader immigration crackdown, there's support is waning for the overall effort in the wake of these two deaths.
So then where do deportations go from here? If Minneapolis's Mayor Jacob Frey and the Governor Tim Walz of Minnesota are successful in de-escalating this, does that provide some sort of roadmap to other governors to then go ahead and say, hey, your federal agents are not welcome here. You are going to have to find a different way to accomplish what you want to when it comes to deportations?
It'll be interesting to see how this gets resolved. I think that will be key to the extent to which it is a roadmap for other states. Clearly, the governor and mayor have been very forceful in their eagerness to see these folks leave their area. At the same time, Walz has in the last day indicated he wants to turn down the temperature. We're going to want to watch what happens with Tom Homan, the border czar that Trump dispatched to Minnesota. He has focused much more on traditional deportation efforts rather than kind of this broader dragnet or these broader operations that Kristi Noem has favored. And so, if we see that kind of refocusing back on more conventional deportation efforts, that could be a de-escalation and a roadmap for other states and cities concerned about immigration enforcement in their backyards.
All right. Super appreciate it, Jen. Thank you so much. Bloomberg News senior reporter Jen Delowy joining us there.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Karen Perry is with us, head of U.S. iShares fixed income strategy over at BlackRock, and she joins us from San Francisco. Karen, how are you?
I'm doing great, Carol. Tim, how are you guys doing?
Doing okay. 2026 definitely off and running. It's Fed Eve, right? We'll get that decision tomorrow. Tell us a little bit about when it comes to fixed income. I always like to start with you guys. You're massive in terms of asset manager and the asset management business. Where are you seeing flows in and out when it comes to the fixed income world already?
This year's already been off to a pretty strong start. So I think last year, investors who took on any sort of duration risk were rewarded. We saw the ag up 7% last year. And this year, I'd say some of those trends are continuing. We're seeing people being more selective about where they get their income. So like positive flows into flexible income funds like BINC. We're also seeing people still wanting to invest internationally. So with the dollar being off this year, we're continuing to see more interest in flows coming back to international fixed income. So think emerging market bonds with EMB or even European high yield people are looking at. And then, of course, I think one of the biggest trends you can't ignore is just the rise of actively managed bond ETFs. They were actually responsible for about 40% of the flows last year. And we saw over 137 launches. So people can now access a lot of their favorite bond managers through the ETF.
Yeah, I just want to read some headlines I mentioned President Trump is set to make a speech in Clive, Iowa. He's right now taking questions at a small business in Urbandale, Iowa. The president, Carol, is saying that China and Japan always wanted to devalue currency. He said the dollar is doing great. If you're watching us on YouTube or Bloomberg Originals, you can see the president live right there answering some questions from reporters.
Yeah, and I don't know exactly what he means by the dollar doing great.
Maybe he was asked about weakness.
Yeah, I guess so. I mean, we're down. I'm looking at the dollar index down another 0.9 percentage point, but we've seen certainly a pullback when it comes to the U.S. currency. You take a look at the major industry developed in the developed world, if you will, and really the dollar at the bottom of the pack. So we definitely have seen some pressure. How does that, Karen, if at all, play into the fixed income world?
I think for a lot of U.S. investors, most bonds are denominated in dollars, so it doesn't impact us very directly. But we've seen a big trend where people are looking at going global, grabbing those international bonds. One of our ETFs, iGov, which is just international bonds in those foreign currencies. So think the euro, yen. It's actually off to a really strong start this year, up almost 2%. So we've seen more people saying, you know what, maybe I want to take advantage of some of the dollar dropping. And then one of the easiest way to do that is with international-based fixed income ETFs. And so I think that's going to continue with more interest this year.
How do you look at this idea of Europe moving away from U.S. Treasuries? Our Bloomberg economics team out with a note that says, no, Europe is not about to sell $3.5 trillion in treasuries. A Sell America strategy, our team writes, is not in Europe's interest. The financial repercussions would be severe given the region's heavy reliance on U.S. dollar funding. Do you agree with that?
I think we see a few countries who made some noise last week about potentially selling off dollar assets. I think it's going to continue to be a major source of liquidity, a major source of stability for a lot of countries. We've seen more volatility, I'd say, in the long end because of it, is investors anticipating that. So I'd say one of the easiest strategies is just move away from super long duration bonds, long duration treasuries in particular. So we've seen a lot of people reallocating back to that belly of the curve, 3 to 7 years, and avoiding some of the long end, which I think is going to get hit most if there's negative international sentiment.
Karen, any signs that you are seeing global investors think that the U.S. is increasingly uninvestable?
We haven't seen that trend yet. I think, if anything, our interest rates are still higher than other countries. And we've even seen interest from international investors into maybe munis as a way to get access to high quality bonds that aren't treasuries. Investment grade credit is also of a lot of interest to investors. Mm-hmm. So, you're moving away from, if the government is going to get more levered, companies actually have very strong balance sheets and have lower levels of leverage. So we've seen, if anything, people are looking towards U.S. corporate bonds as one of the ways to add diversification.
What are the trends that you're already seeing in the first few weeks of this year? You mentioned what we saw last year, but where are you seeing flows just in the last 3 weeks?
Yeah, we've seen IG credit. So we have seen over 900 million come into US IG, which is just the whole corporate credit curve. A lot of interest picking up on long duration municipal bonds. Those are actually on a tax equivalent basis yielding over 6.5%. So you can get some of the same yields you find in high yield, but in munis. So people are looking at adding duration there. And we've just seen more people adding to very short, ultra short exposures, putting that cash to work, trying to squeeze a little bit more out of the front end. And then finally, bond ladders are really popular. For example, our I-bonds ETFs, we've seen over $1 billion come into those this year. Our most popular one is our 2029 IBDU, yielding over 4% with only a 3-year duration. So we're seeing people just stepping out of the front end, go into more of that intermediate exposure.
Is there anything that you are kind of watching out from that Fed decision tomorrow, Karen? Obviously, it's the decision and what you hear from the Fed in the statement, but it really is the press conference, too, with Jay Powell to give a lot more context and color around all of that. He's very careful. It's often, we've seen in the last few meetings, he tends to say very similar things, but I'm just curious in the last 30 seconds that we've got with you, what you will be watching out for and you think is important to fixed income investors.
So, of course, we're watching the main decision. We think the Fed will continue to be on hold. I think they're going to be data dependent. We've seen Fed speak this week, filtering through that they're still waiting for the previous cuts to come through the economy. I think I'm really going to be watching the number of dissenters. Are we going to get a 9-3 or some kind of even more divided decision?
Yeah, always interesting, right? As they play it out and they vote basically and see where it kind of lands. Because we certainly have seen a lot more dissension as of late. Karen, thank you so much. Karen Perry, she's head of U.S. iShares fixed income strategy over at BlackRock.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.